Chapter 1: Accounting in Business. You'll see a numbered statement and a list of terms from A to J. Try to choose the correct letter that best matches the description. Pause the video when needed, and check your answer after. Let's look at number 1. What do we call the process of checking a company's financial reports to see if they follow the rules? The answer is E. Audit. An audit is the process of examining financial records to ensure they follow accounting standards. Let's look at number 2. What is the money a business keeps after paying all its costs and expenses? The answer is B. Net profit. That's the income remaining after all costs are paid. Let's look at number 3. Which group makes international rules for accounting used in many countries? The answer is C. IASB. The International Accounting Standards Board develops international accounting rules. Let's look at number 4. What do we call accountants who help different companies with their finances, taxes, or audits, not just one company? The answer is A. Public accountants. They serve various companies, not just one employer. Let's look at number 5. What word means knowing what is right or wrong in accounting, not just following the law? The answer is G. Ethics. Ethics guide behavior in accounting and all professions. Let's look at number 6. What do we call the steps a company takes to protect its money, follow rules, and keep accurate records? The answer is D. Internal controls. These are checks and balances within the company. Let's look at number 7. What model explains why someone might commit fraud because of pressure, chance, and excuses? The answer is J. Fraud triangle. T. This model explains why fraud happens. It's not just about opportunity. Question number 2. Write the letter A to H that best matches each numbered description. Let's look at number 1. A company provides information in its financial statements that could influence users' decisions. The answer is G. Full disclosure principle. This principle requires companies to share all information that may affect decision-making, beyond just the numbers. Let's look at number 2. Financial statements are prepared with the assumption that the business will continue operating. The answer is F. Going concern assumption. This assumes the business won't be liquidated soon, so assets and liabilities are recorded accordingly. Let's look at number 3. A company records expenses in the same period as the revenues they help to generate. The answer is E. Expense recognition principle. This matches costs to related revenue, ensuring accurate profit measurement in each period. Let's look at number 4. Broad concepts and guidelines used to create financial statements. The answer is H. General accounting principle. These form the foundation for how financial information is measured, recorded, and reported. Let's look at number 5. The financial records of a business are kept separate from those of its owner? The answer is B. Business entity assumption. This ensures personal and business finances are not mixed, providing clarity and legal separation. Let's look at number 6. Revenue is recognized when goods or services are delivered to customers. The answer is C. Revenue recognition principle. Revenue is recorded when it is earned, not when cash is received, giving a more accurate picture of operations. Let's look at number 7. Detailed rules for reporting business events and transactions. The answer is D. Specific accounting principle. These rules apply to particular areas like inventory, leases, or depreciation. Let's look at number 8. Financial information is based on the actual costs paid for items and services. The answer is a measurement principle. This principle requires recording assets and services at their actual purchase cost, not estimated value. Question number 3. Mr. Chen established his business on June 1st. He prepares monthly financial statements. Review each transaction and analyze its effect on the accounting. Let's look at transaction A. For Mr. Chen's business. Mr. Chen invested $70,000 in cash and equipment valued at $15,000. In the accounting equation, both cash and equipment are assets, totaling $85,000. Since this is the owner's investment, it increases owner's equity by $85,000. This keeps the accounting equation in balance. Let's look at transaction B. The company paid $1,500 in cash for office rent for June. In the accounting equation, this payment reduces cash, which is an asset. At the same time, it increases expenses, which reduces equity. So, assets decrease, and equity decreases too. The accounting equation stays in balance. Let's look at transaction C. The company acquired equipment worth $10,000 on credit, to be paid in 30 days. This transaction increases equipment, an asset, and also increases accounts payable, a liability. So, both assets and liabilities increase by $10,000 and the equation stays balanced. Let's look at transaction D. The company performed services for a client and received $2,500 cash immediately. This transaction increases cash, which is an asset, and also increases revenue, which is part of equity. So, both assets and equity increase by $2,500 and the equation stays balanced. Let's look at transaction E. The company completed services for a customer and issued an invoice for $8,000 due in 30 days. Since payment has not yet been received, the amount is recorded as accounts receivable. This means the company has earned revenue, but the cash is still pending. So, assets and equity each increase by $8,000. No change to liabilities. Let's look at transaction F. The company purchased additional equipment for $7,000 and the payment was made in cash. This is a cash transaction, and it does not affect liabilities. Instead, one asset decreases, while another asset increases by the same amount. Let's look at transaction G. The company paid $3,000 in wages to an assistant. Cash decreases by $3,000. Since wages are an expense, they reduce owner's equity. There is no effect on liabilities, because nothing was owed. Let's look at transaction H. The company received $5,000 in cash from the client. It is related to the invoice issued earlier in transaction E, where the company billed $8,000. Cash increases by $5,000. At the same time, accounts receivable decreases by $5,000. Because part of the client's debt has now been paid. Since this is just a conversion from one asset to another, there's no effect on liabilities or equity. Let's look at transaction I. The company paid $10,000 in cash to settle the liability from transaction C. Cash decreases by $10,000. Accounts payable also decreases by $10,000 because the debt has now been settled. Again, this transaction doesn't affect equity. It's just a reduction in both assets and liabilities. Let's look at transaction J. Mr. Chen, the owner, withdrew $2,000 in cash from the business for personal use. This type of transaction is called a withdrawal or drawing, and it reduces both the business's cash and the owner's equity. Liabilities are not affected. Here is a summary of all the transactions from A to J. As you can see, each row shows the impact of a transaction on the accounting equation: assets equal liabilities plus equity. Even though different accounts change, the total always stays balanced. At the bottom, we see the totals: assets equal $89,000, and that matches the total of liabilities plus equity. This proves that the accounting equation remains in balance after all transactions. Question number 4. Jane started a new business on September 1st. A few days later, on September 3rd, she contributed $100,000 to launch the company. By the end of the month, the company had completed a full month of operations. Now, the accounting records show the account balances for that month. These include various expenses, assets, liabilities, and equity-related items. Your task is to use this data to prepare 3 basic financial statements. A. The income statement to summarize revenues and expenses. B. The statement of changes in owner's equity to reflect capital contributions and withdrawals. C. And the balance sheet to show the company's financial position at the end of September. Let's take a look at the income statement. It shows how much Jane's company earned and how much it spent in September. At the top, we see the revenue from consulting services. Below, we list all the expenses. By subtracting expenses from revenues, we arrive at Jane's net profit or loss. Now, let's take a look at the statement of changes in owner's equity. This report explains how the owner's claim on the business, called owner's equity, has changed over the month. We start with the beginning capital, which was $0 since Jane just started her business. Then we add the owner's $100,000 investment, which increases equity. But we also need to subtract the net loss from the income statement. In this case, that's $10,240. And don't forget, Jane also withdrew $5,000 for personal use, which reduces her equity. After accounting for all these changes, the ending capital on September 30th is $84,760. This final amount will appear in the balance sheet under owner's equity. Let's take a look at the balance sheet as of September 30th. This report shows the company's financial position at a specific time. On the left side, we list all the assets the business owns, things like cash, accounts receivable, inventory, land, and equipment. On the right side, we list the liabilities, such as accounts payable that the business still owes. And just below that is owner's equity, which comes from the capital the owner invested, plus profits, minus any withdrawals and losses. If we add up liabilities and owner's equity, it should equal the total assets. That's the foundation of the accounting equation. In this chapter, we explored the basics of accounting in business. We learned about GAAP, ethics, and the importance of internal controls. Then, we reviewed key accounting principles and assumptions that guide how transactions are recorded. We applied the accounting equation and prepared the three core financial statements: the income statement, statement of owner's equity, and balance sheet. These tools help us understand how a business performs and where it stands financially. Great job reaching this point. You're now ready to dive deeper into the accounting cycle. That's a wrap. See you next time.